But those of you who have been with us since last year, you would have joined in his first session. He had a session with us last year where he talked a lot about his journey and he gave a lot of practical tips. So if you missed that part, you can always watch in the YouTube recorded page. You will see his session that he did last year. But today, he's going to go deeper in terms of what he wants to share with us. So it's not going to be as much of the type we had last year. This is particularly something very critical in the aspect of financial modeling, which is the building blocks in financial modeling. So his name is Charles Otoghile. I hope I pronounce it well. I've never even bothered to ask you if I pronounce it well.
Otoghile.
Otoghile. Okay, so
Yeah,
Charles
that's
Otoghile, and he's the head of i5 Data Systems Unlimited. They are also into financial modeling, both the trading and consulting aspect of it, and other things related to data analysis. So he's got a lot of experience, both certification-wise, training-wise, and project-wise. And if you check the event page, I have put the profile to the link to his profile. I'm going to also put it in the chat so yeah, you can always download and see and connect also with him on social media and on LinkedIn. So I'm going to hand over the reins to him. So Mr. Charles, the stage is yours. And if you have any questions, as usual, you know how we do. You can ask as it's progressing. You can drop them in the chat box. I will also draw his attention to it. So, Mr. Charles, the stage is yours. Thanks for being with us today and presenting to us.
Thank you very much. It's a privilege to be here again, and always a privilege to be in the program. We've got a lot to do, so let me just go real quick and then get into what we have to do. Actually, let me share my screen, my desktop. Okay, let me share my desktop. Okay. So I don't know if everybody is seeing my desktop.
Yes.
Okay,
yes.
that's fine. All right, that's fine. So I call them building blocks because in financial modeling, there are really a few things you need to know, but these few things gets to cascade into so many things that you have to build. But if you know these building blocks, you can actually use them to model things that are required in your financial modeling. So I'm going to show you some of them and how they are used, and then hopefully I might be a little fast because we have a short time, but thankfully we have a video that we can go through. You get it? So most of the time, your financial models has a module that is timing. Well, your timing is just about months, but here we are just going to use just direct timings, and the timing we're going, let's just assume that this is January 2021. Okay, and then going forward, we just want to work with about 12 months. So we use the EOMONTH formula to use to generate all other dates. And what I just do here is that I specify a start date, which is this I've entered, and then how many months, 1 month, and then close my bracket. So doing it like this, I'm able to, as if it were, automate all of these dates here. And you can format it in whichever format you want. But here I would just go for a date and then choose to use month and year. So that makes it short, and that is it there. Okay. So what that means is that if I have this somewhere, all I have to do is reference it. And in referencing it, I would ensure that I lock the row. I have to lock the row so that it makes it easy for me to, just copy that date thing anytime, anywhere, and then I have what I have. So I'm going to copy this one and drop it here. This is what I'm talking about, so that it makes it real fast and quick for you to do things. And at any time, at any time you feel like changing something, assuming I was to change this to 2022 now, you see it cascades through my model in its entirety, okay? So let's go back and then see this. So the first one we'll be looking at is actually that which is called the corkscrew model, you see? So for the corkscrew model, I just want to assume that we have, let's start with revenue, because this corkscrew model, you are going to find it very important in things like modeling receivables, modeling payables, modeling items that will be in your balance sheet. You're going to be using this it's a behavior, if you want to ask me, because it tells you, oh, something comes in, I get a balance and so on. Let me just show you what I mean. Let's assume that we have revenue here. Revenue. Let's assume that we have revenue. And let's assume that I want to use the round between function. I want to use the round between to generate revenues. And let's assume that our revenues are between 350 and maybe 550, okay, at any point in time. So I'm going to use this to get revenues. I'm going to copy it and paste it as text. For those who are looking at it, let me just use this. Otherwise, I can use a keyboard shortcut to paste it as a text. You get it? So here we have these revenues. But you all know that in finance, you get it, in finance, your revenue is not cash, you know. So you might want to model a receivable model in your financial model. And this is how you could do it. You could have an opening balance, and you have, actually, in this case, you're going to have additions, that's adds, which is revenue. You get it? So I'm going to just put it like this. And then we are going to have collections. You get it? So we could have less, but this time we're talking about collections. We are talking about a situation where we make a sale. We may not collect the money instantly, and we may have to collect in the future, something like that. So when we have this, we have a closing balance. You get it? And then this, then we are set to go. So I'm going to just have here, let me make it white. I want to make the text white. So how does this work? Actually, because we have additions, we are going to have here linked to this. These are revenues that are coming month on month and coming in, okay? Which is fine. And then the next thing we're going to do, what will be the opening balance? Because in this, my model at the beginning, let's assume it's a new business. I didn't have anything in the previous period. What I'm going to do is my first opening balance will be equal to this point. And this is a very important thing for you to know. The layout of your model matters a lot. In my models, I always have a column for units. I have a column for units. I have a column for inputs just before my actual models that I'm building in here. The reason is that this column helps you to do a lot of things. For example, if I do this, you can see that I have linked to it here. I have linked to it here, and it's helping me to just say, okay, at the beginning there was nothing. Now, if I should take this down now, you would see that I'm going to format it. Where is the format? Yeah. Okay, so I'm going to format it. I don't like to see those zeros whenever they come in. You get it. So what it means is that with this here, I can sum whatever is my opening balance, whatever I got, and then whatever collections, I'm going to deduct them. But for now, what I want you to see is that at the end of the day, I am able to get total revenue for the period, for the year. So if you sum up all of this, let me just sum. If you sum up all of this, you see that what you get is actually the total that you get here. Okay, so that's how that one comes in. All right, so that tells you that your corkscrew model is working because it's some kind of in and out, and it gives you a balance. Now let us look at that of the collections. We may have this assumption that every revenue we earn in a current month, we collect it in a previous month. So that means that whatever we earned in January will be collected in February in all. Now what I just need to do is to come here and put this. I need to format all of this. Okay, so it's like this, and then we just put it all through. So notice that in December we had 542, and that's what's remaining, because in the next month of the following year, that is what you're going to get. So a lot of your modeling would use this kind of blocks. It will use this kind of blocks to build the model as if it were. So I'm going to just log this and go and here. Okay. So the thing is that this is the basic form of the model. This is the basic form of the model, but you could have some variations to it. You see, if I teach you this and tell you that is where it ends, I'll really be telling you lies, because you can have a situation. This is what I'm going to do now. I'm going to take this. I'm going to take this and just paste it here. Okay. Now the reason why this happened was because of okay, I guess I did something wrong here. I'm going to use F4 to just work on this. I think I should leave this one. So this is the one I ought to lock. Okay, I'm going to log the row here because it's linking to revenue up there. So see, one of the things you should be thinking of is how to build your models real quick. Okay, so you can see that copying this and pasting it here, I get the same thing. So I can use this to build any other thing that I want, and then we can go real quick. Okay, so but what I want to do is that there are circumstances where you would find that you're not collecting everything in the second month. There are situations where you might have to collect maybe 60% in the current month, 60% in the current month. Let me just do this. And then for the next month, you might collect the balance. Let's just assume that you're collecting the balance. So that's going to be 1 minus whatever you have here. So always build your model so that even if we want to change certain things, we just change a few things and your model will work. So if I say that we take 70% here, so we'll have 30% here, okay? So that done, we could have anything. I'm not very good with labels, but this is actually our first collection, or can be first installment. And then we have that which would be second. You see, so we are assuming that in all sales that we make, we get 70% the current month, that very month, and then 30% the other month. So if you have this, it looks like a variation to what we have on top here. So what happens at this point, this will just do a change here. This will now change. This would now be a summation. Hello, somebody's somebody's mic is on. All right, thanks very much.
Apologies for that. I've muted the person.
Okay. So here what we actually need to do is to sum these collections together here, because they are now multiple. Sometimes they can be 3, and whatever it is. So what we're going to have here is just the sum. You get it? So that's just the sum. You could put something under it to show that you're summing up everything. You could also show that these are subs. These are subs to this, okay? So once this is done, you know that here, 70%, and what do? I need to lock the column here. I'm going to lock the column here. That's why we have a $ before the D here. So I'm going to take it to my ads revenue, the revenue that I add. Sorry, what I did was this lock the column multiplied by this revenue here. You get it? So don't forget we are subtracting it. You get it? We're subtracting it, and then this will get this. Now it's going to be working with this, because if you click this, you see it's summing all of this. This is just a sub of this one here. You get it? But that's not all, because this is for the current month. Now, for that of the next month, we won't start from this cell. We'll come here, but we'll link it to the revenue that it pertains to. So we're going to say whatever here is 30%, lock the column, multiply it by what we earn in January. So that's it. So we have and then down. Okay, so you can see that this one, I'm going to take this out. This one now tells us what remains here. And if you calculate, you find that 160 is actually 30% of this 542. So it's waiting to be collected in the month ahead. So you can see how understanding this can help you build so many things. Here, if you go to your balance sheet, this is going to be your receivables. This is going to be your receivables down. So you can actually plug this into your receivables in your balance sheet, and you already have that schedule. So there are many other things that behaves like this. If you're modeling payables, they go this way. It's just that it's the opposite of what we have here that you are going to be modeling. You get it, but it's the same format. If maybe you are doing capex, and in order to get your capex addition, actually in capex, what you will be subtracting is depreciation. What you will be adding is the capex addition, capital expense that comes in as addition. And then you can get your balance sheets balance by using this kind of block, this kind of building block to come about it. Now, for some persons, they might say that, what you did was, I would have been able to use the offset function to do it. Actually, I use this method that I've used for you here because I love to, when I'm auditing my formulas, I like to see what is happening. You get it? But let me show you what I mean. Let me just use the top one to just give you an example of what I'm trying to say. So let's assume that we are taking this. We're taking this one, and we're going to replicate it here. And then for this one, rather than just use simple equal to works, I would have used the offset function. And what I would do with the offset function is offset. Then my reference is going to be this revenue. See, so my reference is going to be, now the offset function is asking me how many rows should I move. I don't want you to move through any rows. My reference has defined the rows, so don't move. I want you to stay in this row, okay? And then how many columns do I want? Actually, I want you to, because you see, whatever I will get here must be from a previous period. And so you can see how this column is going to be helpful here. So I'm going to tell you to move backwards, and backwards is -1. If it were forward, it's going to be plus, it's going to be just 1. So you see, nothing comes in there. I wouldn't forget to put my minus sign. But if I go this way, you see, I still get the same thing coming. Yeah, the offset function can tell a lot of people looking at your model that you're a guru. But again, it's just to have the work done. Now, this is what I'm talking about. So if I should hit my F2, it shows me this revenue, you see. And for somebody who may not know much about the offset function, he will struggle to say, okay, you referenced 437 and you have 425 here. Hey, I don't understand what's happening. So it's somebody who knows the offset function that can really understand that actually you're looking backwards this way. And I hope you got that from that. So let's move to yet another. Let's move to yet another interesting. This should be dates. Okay, so here, let me just format this one to stay. Okay, fine. So here, what I want to do is to show you how scenarios are done. Now, what do we mean by scenarios? There are many ways you do scenarios. Most persons get to know when you go to the data and you go to what if analysis. Yes, you can use this to build scenarios. But all too often, we build scenarios like this in what's it called, in financial models, you see. So we could have a situation where we have max. Let me just use that as an option. Let's use this as expected, and then let's use this as mean. And then this can relate to something like inflation. Inflation can relate to something like inflation rates. You get inflation rates, okay? So here we are looking at this time around. Let us have just years so that we keep it, because yes, let's have years here. Okay, 2021. Sorry, we keep it short because most of the time your scenarios would be in your assumption sheet. You get it? So you wouldn't want to make it that way. So here we're going to just come and say that this +1, and let's just go a few years. Let's just go a few years. Okay, let's have it like this. All right. So we might say that, oh, we have some expected predictions for it, maybe some like 14% here, and maybe 13%, and we just put some things there, and then maybe 16%. Okay, so we have this as expected. And then the max, we are saying that it could be anything like this plus what? Maybe 2.5%. You get it. That has to do with formatting this in the. Okay. So that's this. And we are expecting things to be a little better, and then we say that it is going to be this minus 1%. So these are just assumptions. They are nothing related to any real life country also or any of such. So that's what it is. I always like them to have at least one decimal just in case for reality purposes. Okay, so here is it. All right. So when you have something like this, chances are that you want to create something you can call applied rate. So that's applied rates that will be at top here. So maybe our applied rates will just be bold. So the question is, which rate would be the applied rate here? So in building such scenarios, you could come and just somewhere here have the color code for everything that is going to be a drop down, and then do a drop down here. So I'm going to go to data and data validation and come up here, list. And what I want to do is just pick these guys. I want to pick this. Okay, so that's it. Doing that makes it possible for me to make selections here easily. Any user can make selections here. We can make this, and this. Bold. Looks not very visible, so let's leave it black. That's fine. So I can always select here and then and get an applied. So the applied rate is the minimum here, or whatever it is. Now, to get these applied rates here, you could use any way in which you want. You could use the if function to do that, you see. For example, you could have the if function that says that if whatever is here, because now we have to lock it, if whatever is here is equal to this, if it's equal to this, here again, you have to lock the column, because you're going to be dragging your formula this way. You'll be dragging across columns. So you need to lock your column. So if it's this, you will tell it to give me whatever is here. And then you go and say that if this same one, actually we just need to log the column of this one too, it's equal to this, it should give you, sorry, if it's equal to this here, what it should give you is the second one. Else, it should give you the last one. So the last one, we really do not need to do anything about it. So we have two ifs, so we need two closing brackets to close it. And then we get this. And then here we are. So you can see that the minimum is what we have here. And if we should change to expected, it should change to the expected. So let me see what's happening. So good. So you can see here that I have an issue with my formula here, and it's the green guy. So the green guy, I ought to have locked him. I ought to have locked the column. So I'm going back to this beginning, and then this guy, I need to lock the column here, okay? And there we are. Okay, so let's see if it's working. Let's go to max. So fine. So everything is working. So your model, the calculating for inflation year in, year out, can actually be looking at these cells, equal to these cells. So anytime the user changes it, we see where it comes to, okay? Now, like I was saying, some persons may feel that, well, this is something they cannot use. Actually, you could use your index. You see, your index. You could use your index and match function. You could even use your VLOOKUP to do to work with this. So index, the array of the index is going to be the values that you want to bring in. So I want to bring in these values in it. I want to bring in these values, and again, I don't need to lock it, because when I copy it through, I want it to be looking through each and every one of them. Sometimes when we implement index, we tend to select the entire table and then go about working through columns and all of that. If you look at the implementation, the column is optional. So why bring in the column into your problems? So there's no need for us to do that. You get it? So we just say this, and we use the match function. And here we are going to match with this. So we're going to lock it in here. Just lock that column so that it sticks to this column. And then that's where we'll always be looking at. And the next thing we'll do, where is it going to match? So it's going to match this one. And if we're going to log this, so if you recall what the match function does, it's going to return a 1, because in this list I have 1 here. It's going to return 2 and 3 here, and that helps our match function, our index and match function. So with this one, I think I can go this way, just put this one inside. So max is giving us this, and then we have the expected, and then we have the mean. Okay, so this is one way in which you can build scenarios in Excel. Now, I want to show you another one this time. You know, sometimes some of us may have experienced it. You have your boss tells you that, okay, you know what, we want a different, we have multiple scenarios that we want to test. You get it, multiple scenarios that I want to test. And what we should be doing is you can just copy the entire Excel file. You know, you'll be told to copy the entire Excel file and then build another scenario, change what you have here for it. Actually, you don't need to do that because Excel still provides a tool for us to do that. Let's look at this other building block. Assume that you are told that we want to test for inflation. We want to test for inflation rate. We want to test for interest rate. And we want to test for maybe FX. You see? And you are now told that the scenarios is such that, let me just copy this, use it here. So, yes, what was this? Normally in a financial model, this should, I should color code this to show that it's hard coded. That's good practice. If it's hard coded, just give it that, you know. So I'm going to hit my F4 to make that happen. Your F4 actually does a lot of things. You see, apart from help you to put your $ in your formulas, if I have, you know, come here and then just, you know, do this, I can come here and just hit my F4 and it will implement the previous format that I have just done. So that's good. Maybe when you're through with your model, you just see some of those things you want to fix. You can always use this to do that real quick. So interest rates, let's just say we have 9%, we have 11%. Now 11%. Again, this does not relate to anything. We are just looking at building blocks that you can use to build realities. If when the model calls for it. Okay, so we have this one. Okay, so let's assume this is this, and let's also assume for this one, let's do our 380, and let's just leave it 38003. Might resemble anything like Nigeria, but it's not. This is just practice. Huh? Okay, so here, what we are trying to say is that this is just one combination of what you want to test. But again, you might be expected to test another combination because most of these things you are trying to look ahead. You might even check some research, some websites and so on like that, and you'll find that you have sometimes 3 different forecasts, and you want to bring it in like this. So this might be our max. Might be our max option. These are max option, and let me do that. This might be our expected option. And then this could take any labels that are ideal for your model. Okay, and let me just create one more. So you don't need to go and just make another copy of your Excel worksheet or whatsoever. You really don't need that in this case. So that's how it goes. So you have three different. So if your boss says, oh, I don't think this works, but somebody said that this may work. Okay, let's keep it there. Let's create another one. And let's create a mean option. Okay, mean, like minimum option. Okay, so having this, this is our max option. And what I'm going to do is that, so that we would be fast, let's just take this and subtract 2% here. And bring it down, copying it down. I don't need this again. Okay. This guy will come and say it's going to be 470 here. And then let's just, this other guy, we're going to say it's equal to whatever this is, and let's just do -1%, and let this go for them. So here you can see how multiple scenarios can be flexed to get you whatever you want. Let's say 510 here. Sorry, that's not a prayer for Nigeria. All right, so we have three options here. So what happens is, setting it up, you just have to create one other option, one here. This one is actually your applied. This one is actually your applied option. Okay, so here, so that anybody looking at your model will exactly see what to do. So this place is going to be empty now. Okay, what I will do is just copy these empty cells here. Control arrow will do that, what I just did now. So now I want to try to get it. Now, this is a function that is rarely used. And sometimes when I build models, most of the models may not come requiring this. You can easily forget how to implement it, but here is it. It's actually the index function still. But you see, when you bring out the index function, there are two. There's the array implementation, there's the reference implementation. So actually, what we want to use is the reference implementation. Now, this reference here has a relationship to area. You see, what it's trying to do, it sees all of these as areas. It sees them as area. So actually, I have area 1, area 2, area 3 here. You get it? So I can refer to them using an area number of area 1, area 2, and area 3. You get it? But the thing is that I have to give him a reference of the area. And this is where it's funny, because the IntelliSense here would not really tell us that, see what actually we should do. Actually, you need to open a bracket here. And that bracket is going to pick this, comma, this one, comma, and this one. So I've established 3 areas here for it. You get it? I've established 3 areas for it. So each of the areas, when I copy this way, I want them to just change along, to move along. You get it? So those are the areas. I'm going to close it with a bracket. So once I close it and do this, you see it's asking me for row. You get it? So it's asking me for which row do you want to implement here. So let me just do this. Let me just say that I want to implement row 1 here, comma. And then it's going to ask me for column. Actually, I don't need columns because I have just decided to select them. Like if I had selected all of this, I will be busy giving it columns to do. So I don't need that one. So it says area. So I'm going to just put 1 here as my area and then hit my enter button. What do you notice that it did? What it did is it gave me this. Why? Because this is area 1 and this is row 1. You get it? So if I had come and say row 2 here, if I had done 2 here, it's going to give me 9 here. You get it? What if I had said that go to area 2 here? You see what it goes to do? It gives me this. So because I can play with this, I can actually have a scenario that tells me what area, what option, you get it, that we are looking at. You see, so what you can do is to just have okay, we can just have this here. We create a data validation here and a list here. Go for a list, and we just have 1, 2, 3 because we have 3 of those areas. So what that means is that for the area, I can just reference this cell and lock it. I'm good to lock it. You get it? So sorry, because I don't have this. Of course, we can use we can just use an if arrow to do that, but that's because I have not selected anything here. Okay, so where am I? Yes, here. Okay, so let's just be there. So if I choose 3, it's going to go all the way down and pick this. So that's really fine. So now we can create our formulas to say that this guy should just be 1. Okay. So that's for 3 now. It's looking at that for 3 here. Let me just have this to be 1. Okay. So now we can adopt this formula here too. You know, this formula, we can bring it here, you know, and paste it. But this time around, it's going to be looking at 2. We can actually make the formula a little more complex by bringing maybe our count to count things to determine 1, 2, because if I should do a count here, I'm going to get 1 here, I'm going to get 2 here, I'm going to get 3 here, and that could flow into the formula, you know, to make it look much more flexible. You get it? So I'm just going to just come here and just this time around 3. So that's it. So our model will come here to pick whatever it wants to pick. So if I should come here and choose 2, all of them are going to change, and then we can have them apply to our formulas in that way. Okay. All right, let's quickly go to reducing balances. Okay. Let's how do we go with this one now? All right, let's use the years. Let's just still use this one. Let's use them to represent years. You can also use it for months, because sometimes you have a model where you have to build through 5 years. That's about 60 periods, 60 months. You could also use this, but for this illustration, I'm going to just use years so that they can be within, you know. So we see what happens. So let's assume that actually we have this capex spend. We are buying capex and all of that. Here we have maybe we bought 40, and here we bought maybe we came here to buy 50, and here we came here to buy 60. Okay, all right, fine. So most of the time you will be required to come up with what you call depreciation schedule. You get it? Be required to come up with depreciation schedule. To come up with that depreciation schedule, you might need to use building blocks like what we have here. So the first thing is that somehow, somewhere, you need to turn this table. You need to transpose it. Well, some people can use the transpose formula, but what I usually do is still use my index formula. You can also use the offset function to do this. So what I just need to do is that I need these guys, I need these guys to come in. And sorry, first we have, this is 1, 2, or you could just close. We have 1, 2, 3, 4, 5. I think 5 is 1, whatever it is. So that helps you to invert. So it's index. First thing it takes is what I want to bring in, because I would actually need it. My index is there. I'm going to lock it, comma. It asks me for rows. I don't really have rows, so I'm going to just put a comma there. Then for the column, I will just do this one. You get it? I'll just take this one, and I think this should work. Okay, so this should work. So here I have all, I don't have a sixth one. So I have here all my years. And what I do is I want to get my values, these values in here. You get it. So again, you can play with your index function. You can use your VLOOKUP. You could use whatever. So, but let me just use the index function here. And for index function, what I really want is this. Okay. So I'm going to lock it, comma. I want it to do a match. What is the match going to be? It's going to match the year value. So all I want it to do is match this. I want it to match this. And from where? And I'm going to just pick this. I'm going to lock it because of what I want to do, copying it. And then that's it. So here it is, okay? So the next thing I want to do is that I want to, let's assume that each of these things is going to depreciate for, each of them would depreciate for 3 years. Let's just do 3 years so that we can see some patterns that will come of it, okay? So I want to move this one because I need more space. In real models, I will be creating more columns here to help me out in that, but let's just go this way. So here it is. So so let's assume that it takes 5 years. You get it? So you can do this for different kinds. For example, you might find out that buildings is 25 years, machineries is maybe 5 years, office equipment is maybe 3 years, and so on like that. You will need to do it for them separately. You get it? Okay. So what we do here is just assume it's 3 years. It simply means that for every year, each of these things should depreciate with this 3 years. So I'm going to lock it up there, and then this is what I should be subtracting from it. You get it? This is what I should be subtracting. Let's just do, how many years do I have? 1, 2, 3, 1, 2, 3, 4, 5. Okay. All right. So, let me see if I can get some rounded figures. Okay, so this is fine. So I need to use this to depreciate them. Okay. So now that you have gotten what the depreciation value is, what you can now do is to determine what you are depreciating and at what time that you are depreciating it. So I could have come here to say this is equal to this and lock it, and then come and start to copy it. I mean, we can't do that if we have so many like that of 60 months and so on like that. No, we have to find a way to use the formula to do just that. So how do we do that? So what we do is we tell the formula, we tell Excel that, you know, give me the max, the minimum, because whatever you are depreciating in every particular period will be smaller than the total balance that you have. So I can tell it that give me this, you get it, and I'm going to lock it to the column. I tell it to give me this, the minimum of this, or give me some And I'm going to tell you why that happens. Give me this, lock it to the column, lock it to the column, and say minus the sum of this. So that's why sometimes leaving an empty, that input column helps a lot. So I'm going to do this to this. So what am I trying to do here actually? What I'm trying to do is that I'm trying to track what I've depreciated previously. You get it? So maybe we would understand it better when we look at the formula. So I'm going to lock this one. I'm not going to lock this. I'm going to lock this one. So you'll see the behavior of what's happening. So if I should copy it, if I should copy it down, in fact, I can take this further. So if I should copy it down, can you notice that it stops at 40? So it tells me that, sorry, there is nothing more to do. You have depreciated it in its entirety. You get it? So what is it doing here? You would appreciate it the most. So if I come here, you can see what it's doing. It's saying, give me the minimum of 10, or give me 40 minus the sum. So it will sum all what I have depreciated, like your historical depreciation. It sums all of those ones, subtract it from the total of 40. And that is why when it got here, it saw that there's actually nothing for it to do. You get it? It's asking for the minimum. Now, you will understand this. So see, this entire one here, I'm going to select it and hit my F9 button. And then you'll see that it's giving us 0. Because 40 minus previous 40 is going to be 0, and it's going to stop there. Okay, so you can use this to build your depreciation model. And then at the end of the day, if you sum all what you have, you are going to have what the depreciation for that period is. Okay, real quick, let me just finish in about 2 minutes. I should be through with this. Now, there's a problem here. The problem is that I didn't buy these things in the same year, but they are depreciating in this order. Now, that's wrong. So what we do is to come up and set up something which we call, let me put it here, which we call time flag. They're actually flags, you get it? So I'm going to create flags like this. And these flags are going to take this same thing. You see, it's going to take this same thing. Let me just pick this and down. Okay, so it's going to use these ones. So what would the time flags do? The time flags is going to start here. It's going to tell me that if this is equal to this, I'm going to lock the row here because I'll be copying down. You see, I'll lock the row here, but here I'm going to lock the column here. So if this is equal to this, you just give me 1. Give me 1. Else give me what? Else give me this other place like that. So you find out that this your empty column here helps a lot in much of your of what you are building. You get it? I'm not going to lock it, and I have reasons why I will not lock it. So that's why you see that your relative and absolute referencing is a key tool when you do financial modeling, okay? So I'm going to close like this and hit, and then just here, like this. I'm going to copy it down, and I'll just format it with this. I'll just format it with this. I don't want all of this, so fine. These are actually time flag. What is it saying? It's saying that if I've bought something here, start depreciation here. If you have not bought something here, don't depreciate anything at all. Go and start from when it is bought. So at this point, I can now come to, make this formula and say times, multiply by this. You get it? So I'm going to do this here, copy, and then down here. So see what happens. At the point where we have bought it, it will start from there and start depreciating further, and then you will be able to sum. So if I sum all of this, definitely I should get my total depreciation for 2021. If we were to do it monthly, it's the same thing. It's the same format. Everything is the same. So you just use this understanding to build it, and then you would definitely get your answers that way. Well, because of time, this is the much I can take. I've done a lot of this on my YouTube channel also. So if you find it interesting, you can always go there to see more. Because when I was learning financial modeling, I was busy trying to understand back then in school, they'll tell you principles of this, and then you apply the principles. So I was just trying to summarize things as a building blocks, and I know that using them, I can use it for so many things. So this is not the only thing you can do this for. You can do it for things where you have to amortize, for example, licenses and all of that. You can use it to build those models and then get your amortization schedule. You get it? Anything that has to do with reducing balances, you can always implement this kind of structure and see achieve your goal.
Okay, thanks a lot. So there are questions already.
Okay.
So let's see. Someone was asking about the lock-in, but I think I managed to answer, and the person seems happy with the answer already.
Okay, thanks very much.
Yeah, I can also see someone's hands up too. So okay, so that means there are three questions, two already written, and then one person's hand up. So Sadiq is asking that is it a good practice to add code the variability in max and min scenario? So
okay.
Okay.
Let me. What do I do? Okay, actually, the max and the mean, if you have collected data from somewhere that tells you this is projections, why? Just put them as hard codes. There is no problem about that. The only thing is that have a way of indicating that this thing is a hard code. For example, you could use a fill color, any fill color of your choice, but most of the time we use the blue color. Or you could say, okay, I don't want to use the fill color. I want to use the blue font color to indicate that it is hard coded. As long as it is an assumption, it's all good to hard code. However, when you are building your assumptions, there are times where you want to build a forecast, not really based on any science or so. Like you can see what I was doing there, I was saying, okay, the minimum should just be this value minus 1 and so on like that. If you think that a formula will best suit your inputs, then use a formula to achieve it. You get it?
Okay, so well, exactly. So I told him that as an attempt that even though I'm going to pass the question to you, but exactly what you said, because they are inputs, definitely if you get them directly from research or someone, it will be
they can go in that way.
He asked another question. So he says, how do we align the formula for depreciation to accommodate year of purchase when we expect the asset to depreciate by 50%? Mr. Sadi, can you unmute? So maybe since you are even on this in the session now, instead of me reading your questions, you can even ask him, and if you are not happy with any answer to, you can say, oh, what? Are you able to unmute?
Okay, yes, thank you very much.
All right. Sir.
Yeah, okay. With respect to the first questions, like for inflation, for instance, when we are trying to check the variability. You just added, like, say, on the maximum side, we have 2%. Then on the minimum side, we have minus 1%. Now, what if in a situation you have completed your model?
Okay.
And you now have a situation whereby your boss come and say inflation is not minus 1%, it is going to be 3% lower. That is why I'm asking for the reason why, whether we could input it in a formula instead of.
Very, very good question. Very good question. You see, like I mentioned while I was putting these things together, I was actually interested in showing you building blocks and not actually some of those, because if you notice in my own, I was hard coding inside the formula.
Yes.
Now, that's not best practice. You see, you could have a cell, you could have somewhere where you have, you have indicated that, okay, it's going to be 1% less than the expected, or 1% higher than the expected. So you're going to put it there in that way and then link to that cell. So when my boss comes and says, no, it's not 1%, it's 3%, just go and change your 3% and it would flow. You get it? That is best practice. And you're asking that question. I know you are implementing best practice.
Thank you very much. Then on the second question is on the depreciation. In the first year of depreciation, you always depreciate by half instead of the normal yearly depreciation.
Okay.
Because we don't know when the asset is purchased. It could have been purchased at the middle of that particular year.
Yes.
So, but when because I love the formula you use so much, it's an insight. I got an insight there. First time I'm seeing it, and I really enjoy it. But I'm trying to see how we can align that formula to accommodate that, because that has always been one of the issues associated with depreciation.
Okay, good question. So one thing I will tell you is that financial models are not cut in stone. In other words, that the financial model is built that way does not mean that it will be implemented that way. There are going to be some variances, you see. So when you are modeling year on year, you get it. Like you mentioned, what if the asset was bought at the middle of the year? So for me, I can't remember modeling year on year because I don't like it. Even if a client tells me model year on year, I'm going to tell him, okay, I'll give you the year on year view of what it is. But I will model month on month, because month on month, whenever an asset is said to have dropped in, I would start my depreciation at that particular month, giving the same structure. You get it? Now, the thing is that the year on year covers a lot of things. From what you are saying, I know you are used to certain models. Sometimes for a full year, you will see that your cash flow is positive. But when you go month on month, you see some months are negative. And that means that you need to go for more cash and so on like that. So when you are modeling, you meet with some of those problems. So when you meet with some of those problems, you have to find a way to contain them. Now, to finally answer that question you are mentioning, you can decide. What I did here was just say, okay, I use the year that it's going to depreciate 4 years. You get it? So the question is, why can't it depreciate at 3.5 years? It could. And then in that way, you will see that your minimum is going to peak. It's going to peak something smaller at the end of the year into the 5th year, as if it were, you see. So it can work that way, and then you will get your model working right. But the thing is that your financial models are more or less assumptions. By the time you implement them, you are going to get some variations. What we try to do is that we get a good percentage of our models to be what will happen in reality.
Thank you very much.
Welcome, sir.
Okay, thank you. So, Mr. Taiwo, your hand is up. The floor is yours.
Okay. Thank you. So I don't have a background in finance. But I'm really interested.
I had to sit very well so that I can answer this question. Yeah, it's nice to have you around. Thank you.
Thank you. Thank you. Thank you. Let me improve my lighting. So it's not much of a difficult. So I just need some clarity.
Please do.
Now, a lot of the methodologies that you've displayed today are very useful in supply chain planning. The thinking is very similar. Depreciating shelf life of products, sales depleting your stock on hand on a month-to-month basis.
Good, that's another application. Very good.
Or a week-to-week basis. Then you have your replenishments coming cyclical. Maybe the replenishments are coming every 2 months or every 1 month. So it bulks up your inventory, and then your stock is depleting on a week-to-week basis. Now, the challenge with in supply chain for medium-sized companies, when I say medium-sized, I mean maybe annual revenue like 200 million naira. The challenge is that the businesses are not very big enough to invest in SAPs, SAP, Oracle, and so for the analysts, they need to be able to structure, model the supply chain flows the way you've done. One problem all of us face is scenario planning. And scenario planning in supply chain planning is the same as you've done it here, but the demands are more. So your portfolio is 40 SKUs, 40 units.
Wow.
For each of the 40 units, maybe per time, due to global constraints around shipping, 3 of those items are not going to be available at the time they should be, or something has happened, and at the beginning of the year, your assumption was that you will have January to December. Your cash flow projections are based on sales from January to December, but you can see that in the middle of the year, for the next 3 months, it will be out. So your scenario planning has to be per item. How do you implement that? I can see your scenario planning is for only one item, if I'm thinking about it correctly.
Yes.
So if you now have to do 40 items, so for scenario 1, item 1, it won't be available from June till September. Item 2, it won't be available from October till December. 3, 4. How do you implement that? Is there a body of knowledge that can help me survive? Thank you.
Okay. Now, in the finance world, you notice that actually, if I were to do this for our fixed asset schedule, it's going to be a lot of items. But you see that your fixed assets are now broken into parts, usually. So in financial modeling, in our inputs, we'll have a place where we have classified each of those items as to those that are 5 years, those that are 4 years, those that are 10 years, and so on. You classify them, and then you now take that classification. Sometimes the classification is not more than 6 items, and then we use them that way and continuously, you see. But in supply chains, having my thinking hat up here, I would say we will go to Power BI to do that, because one is that you can the volume of data is going to be quite large,
huge,
from what
really
you are
huge.
telling me, very huge. And then what might be better, because what we have done here, we can also implement it in Power BI using the functions that are by all those time intelligence functions can help us. However, much of our data will be picking, from our forecast. Our forecast database. It will be picking from our forecast database and then coming up with this schedule. But with Excel, we may struggle because of the volume. Except if it's, like you said, a small business. But if it's like a shipping company, we'll struggle.
Okay. Yeah. Thank you.
You're welcome. Except if you are comfortable with classifying them to smaller classification.
Families, brand.
Yeah, so brand, good. That is when we could do that.
Okay, thank you.
Maybe also just to say, if you also don't mind, because sometimes I work on project finance that we just create many scenarios around like a lot of items, and they prefer Excel. They don't even want to use something else because you have to send them. So you might just have to swallow the pill.
Yeah, yes.
Find a week,
yes.
a day and just do it once and for all.
Okay.
Someone is asking, so Chibuzo is asking by how much variation is best practice? And I'm not sure I understand the context. Mr. Chibuzo, do you want to unmute and maybe give us ask your question so that you will answer it within the right context? Or Mr. Charles, do you understand what it means?
I don't. What I'm thinking is maybe is it he or she? I don't know. Okay, what I'm thinking is maybe he's saying, okay, if I'm forecasting, by how much variation should I do my forecast and so on. If that is what is being asked, like I mentioned, I wasn't trying to do what was ideal in this because I was just trying to show you how the model flows. But if it were in reality we were to do an analysis, I would go and look at trends. I will analyze trends. For example, if it is what do you call it, foreign exchange rates to naira, I want to forecast trends. I want to look at some of the variables that drives this forecast. For example, crude oil prices tends to drive FX rates and so on like that. So I'll use some of those patterns to get what I would use for my forecast. It should be informed. There should be a science to your forecast. You get it? So that would be my response to that.
Okay, so I think finally, Mr. Dapo, your hand is up. I guess I don't know if it's a contribution or a question but yes, sir, we can hear you.
Good afternoon.
Good
Good afternoon, everyone.
Good afternoon.
Mr. Charles,
good afternoon, sir.
Again, sir.
Thank you very much.
Yes, I got interested in Mr. Taiwo Moyosore's question, right? When he mentioned SAP and some other ERP applications like that, right? I know that just like Mr. Charles and Mr. Michael have said, that there are some things that you definitely struggle to do with Excel, right? In some first year applications, ERP applications, you can actually do what we call advanced depreciation, right? And talking about advanced depreciation, I'll give you an instance quickly. Now, when you buy motor vehicles, and probably organization policy says depreciate at 30% or 33%, definitely we know if you're, and again, depending on your depreciation method, whether using balance or straight line method.
Exactly.
Straight line method, we definitely know how that is going to go down the line, right? But there are instances when you cannot use either of these normal depreciation method. Why? Because of your kind of business. And I'll give you an example. Look at a construction company that is using cranes for construction, right? Now, in our own environment, you agree with me that we have two seasons, the dry season and the rainy season. During the rainy season, they most times just lie fallow, not doing anything, right? And they get to do much work during the dry season. Now, my point is, during the rainy season, you cannot depreciate them because they are not working. I hope you understand my point. So
yes,
there's a way you get to depreciate them, right? Based on the type of, on the nature of what they do. So we have advanced type of depreciation, right, in some top tier ERP. So since you mentioned SAP, probably it's something you want to, do some more insight or research to see if it's something I can give you what you need. Right? Thank you, sir.
Yeah, so that's a fine input. I recently did something on a query business and so on like that. So those thoughts actually came in. But you see, like I said, models are not cast in stones. So if, for example, we say for the dry season period, it's going to depreciate by so percent, but in other periods, it's going to depreciate by maybe X percent. So in models, what we might try to do is weighted average of what the percent would be and then use them. The thing is that they are just models. They approximate reality. They are not actually reality, you know. So, but that is why, you see, this is why ERP applications come in, because some of what we do in our raw Excel might be difficult. Some of what the ERPs do, rather, might be difficult in Excel. So that is why you can see Power BI comes in with some more complex time intelligence functions that we can find in Excel. So the thing is for us to, one, identify the problem, and in such forums like this, find a common solution to address them.
Okay. So there's someone whose hand was up, Temitope, then suddenly your hand went down. What happened?
Maybe we answered the question.
Okay. If you still want to say something, you can. Your hand is up again. Okay.
Yes. Thank you very much, Mr. Charles. Really enjoy your section. God bless you.
Thank you very much, sir. Same to you.
Yes, sir. Yes, I want to ask one question. Actually, I once faced the problem while modeling, what's it called, a statement of financial position. They after computing the cash flow statement, I use the balance on the cash flow statement as the figure or value for cash. And cash equivalent.
Yes.
To be automatic, to be flexible.
Yes.
But the client, the owner of the case, was telling me that he doesn't want the cash and cash equivalent to be above a particular level. That any excess of those cash on the cash from cash flow statement should go to investments.
Something
yes. Something
savings account.
Savings account, not even savings account, something that can bring interest for the company in form of a maybe short-term investment into in a bank or finance institute, as the case may be. So I'm not asking, how can I make that one possible? Somebody told me that I can make use of min and max stuff, but I tried all my possible best, I could not. So I said, let me ask this kind of question, since I have expert now in the house. Thank you very much, sir.
You're welcome. I think I've solved that in one of my videos on my YouTube channel, but I will tell you how it flows. So what you do in such a situation is ask your client or the company, what is the minimum cash that you want to hold? So after you have done your cash flow and everything, that your ending cash balance will now be an input to this other model that you want to do now. So you will now bring your ending balance down. You get it? And then you will now bring maybe the person says, okay, 5 million, because you cannot just empty your account. You just don't know when you need cash to do one or two things. So you will now come, the next row, put in this person's minimum cash balance that he wants. So you will now see that sometimes your cash flow balance is higher than the minimum balance he wants to keep. For example, at a particular period, we may have 15 million, whereas he wants it to be 5 million. That's just it. So if you now use mean, you get it? This time you are using minimum because you are looking for where a situation where your cash flow balance is higher than the minimum balance they want to keep. You get it? It's higher than the minimum balance they want to keep. So what you now do then is use your mean. What's the mean between minimum balance and then your cash flow balance? It will shoot them out. It will give you the result. So when you find the difference, you now know what you are going to put in savings account. So you now build a block that will now charge interest on that excess from your cash flow. and then that will now feed into your cash. But take note, when you were asking the question, I thought you were coming through circular reference. Each of these things is going to create a circular reference.
Yes,
and
circular reference. Yes.
Yes.
You're right.
So
Right,
you can't run away from it, because you have met it first in the cash flow. Now you are meeting it again in determining minimum balance, and then you want to charge interest again on that excess and return it to your cash flow. You just need to enable circular reference from your Excel options.
Okay.
Yeah.
Thank you very much, sir. I really appreciate your contribution. God bless you.
Yes. Yeah, you're welcome.
So I think we'll have to close the session now. Let me just check if there is any other questions pending. Okay, I think you've answered all the questions, sir. So thanks a lot.
You're welcome.
Your time today, sir, and we hope to have you again.
Thank you, everybody, for giving me a sense of achievement. I appreciate that.
I was enjoying the questions that came towards the end.
Yeah, they were quite interesting.
Thank you, everybody, and as usual, have a nice Sunday. If you're interested in the other sessions that are happening, the Excel and the Power BI, I'll post the link. Later on. Once I end this meeting, you can always see the chat. So I'll post the link in the chat. But we need to end the meeting. We need to let our speaker go to rest and maybe have lunch.
Prepared for the next
I'm prepared
class.
for the. So thank you very, very much. It's been a pleasure. And Mr. Charles, we appreciate your time and your very meticulous way of taking us through what you have to share. Thanks a lot. And to everybody, thank you. To all the contributors too, Mr. Taiwo, Mr. Dakpo, Mr. Sadiq, Mr. Temitope, thank you very much and have a nice Sunday.
Yeah, bye-bye. Yeah.